And so this, in combination with an elimination of the expectation of inflation, of accelerating inflation, gave us the big reduction in interest rates, in mortgage rates. But when you compare Canada with the United States, we had an even bigger housing boom, because here's the yellow line here is the building of houses, and you can see Canada had an even bigger housing boom than they had in the United States. What we're looking at here is the percentage of total gross national product which was being generated in investment in the housing sector. And as you can see, the yellow line, which is Canada, is at a higher level than the US. So we got to dig some deeper. So far we are saying things are about the same in both countries from the point of view of monetary policy. If anything, Canada had a bigger housing boom. So why did things fall apart in the US and not in Canada? Now we're getting somewhere, and the answers are going to get even more complex. A recent study by former Fraser Institute author Stan Leibowitz, entitled Anatomy of a Train Wreck, provides a plausible answer. Now I have to back up a bit and remind you that the financial sector is basically a collection of regulations. Regulations are the keystone of the modern financial management. The governance structure of most financial institutions is mostly imposed by governments and by, like, the SEC and accounting conventions. Some key aspects of mortgage provision were changed in the US over a period of 8 years leading up to the super bust. And ladies and gentlemen, I bet you not 1 in a million people realized that this was happening. But it was happening, and I'm going to show you how it happened. That those who sponsored this change in standards and change in the regulations, in the effective regulations, had the best of intentions, namely to get more people into home ownership, and particularly people with low incomes. And of course, in the end, these wonderful good intentions have produced a catastrophic result. Now, I wish I had more time to go through and talk to all about the development of the institutions around mortgages in the United States. But if you look down this list, you'll see some things that you will recognize, like the creation of Fannie Mae in 1937, like the creation of Ginnie Mae in 1938, like the creation of Freddie Mac in 1970. These are all names that you recognize. But did you know, and I'm going to plant this as a thought in your mind as we go forward here, that more than 2/3 of all of those securitized toxic assets that everybody talks about were created by those 3 organizations? Everybody thinks that this was all done by a bunch of, second-rate and not very conscientious and so on mortgage brokers. In fact, more than 2/3 of all of the securitized mortgages that are produced in the United States were produced by these organizations. And so the US government has had a very long hand in the mortgage market and in how it functioned and whether it was performing well or not performing well. And as I say, I don't have time to talk about all of them, but now I show you a few more things. They passed legislation. Not only did they create these megaliths, these huge, and by the way, but these are huge interventions in the mortgage market by the government of the United States. Now, these are some of the legislation that they passed. In 1975, the House Mortgage Disclosure Act, you had to disclose details about mortgage applicants and put them out there for everybody to look at them. Then came the Community Reinvestment Act, 1977, and this was to try to force lenders to lend more money to places that people in Congress thought more money should be going to, namely inner city and lower income sections of the territory in which banks were operating. Now, I must underline the point that in passing this act, what Congress was saying is, bank, we're going to score you on how well you do at providing loans to low-income people and to minorities. And your score, we're going to take into account when you next apply to have a new branch. We're going to look at your score, and if your score is not good, we're not going to give you your new branch, or we're not going to allow you to expand into a certain territory, and so on. So this wasn't just any namby-pamby stuff. This was the real guts of how banks operate. And if you go on the internet, you'll find that there are all kinds of systems that banks have had to buy in order to manage themselves to comply with this act. So in 1991, they had another great idea. They said, you know what? The data we're collecting is not good enough about who gets mortgages and who doesn't. So in 1991, they added your minority status, race, to the list of things that they were going to monitor to make sure that they completely politicized this process. So then in 1992, it was quite natural that, now do people recognize the name Richard Siren? Richard Siren used to run Freddie Mac, and so he went over to run the Federal Reserve Bank of Boston, and he had a study done to find out who was giving more, who were getting rejected by banks, and the study found that, sure enough, minorities were being discriminated against. Good risk minorities, low risk minorities were being discriminated against. And so the Boston Federal Reserve issued a handbook regarding CRA loans and mortgages, and everybody that I have talked to says, oh yeah, that was Richard trying to politicize this thing so that he could get more focus on this, because he genuinely wanted more people with low incomes and in minority status to get more access to mortgage money. I'm going to talk to you a little bit now about the handbook that is distributed. Imagine you're a banker, okay, and the Federal Reserve is your what? Is your God. And now the guy who's your God in your particular area starts distributing this handbook to your colleagues, and it's how to survive in the CRA world. Well, it starts off by, did you know, just in case you didn't, failure to comply with Equal Credit Opportunity Act or Regulation B can subject you to your financial institution to civil liability for actual and punitive damages, $10,000 per individual instance, and up to $500,000 or 1% of your net assets. Now, just following the introduction comes this wonderful phrase: even the most determined lending institution will have difficulty cultivating business from minority customers if its underwriting standards contain arbitrary or unreasonable measures of creditworthiness. Now, what the hell does that mean? I mean, really, ladies and gentlemen, what does that mean? Arbitrary and unreasonable measures of creditworthiness. I mean, you're either creditworthy or you're not, right? This is not something about which there's a lot of vagueness, we thought. But the book goes on. How can you avoid having arbitrary and unreasonable creditworthiness standards? Well, one, ignore the lack of a credit history, allow higher debt service to income ratios, don't require the mortgagor to have a down payment, don't worry too much about documentable income sources, but do allow unemployment insurance and welfare payments to count. In other words, get into ninja loans, no income, no job, no assets. That's what they were telling them. This ninja is a recent term, but ladies and gentlemen, this booklet was produced in 1992 and was bouncing around in the community. Now, where does lending of this kind take attitudes toward lending in general, we have to ask? Because, you know, when a bank gets this book from the Federal Reserve on its desk, you know, you're a lending officer in the bank, right? So now, okay, this is for CRA loans. This is what the Fed thinks would be a good thing for us to do. Now, how long do you think it's going to take if you apply this standard to the least credit-worthy people who you know are going to default sooner or later? What kind of standard do you apply to people who there's a reasonable chance that they aren't going to default?